Hey everyone, and welcome back to Everything Tesla Stock. Today we're turning to a well-known Tesla stock analyst and landlord influence, Kevin Paffrath, who's got a YouTube channel called Meet Kevin. In his last few videos, Kevin's been explaining how the current economic situation influences Tesla and its stock price, as well as his take on what investors can expect regarding current stock prices and Tesla's future. If you're interested in learning more about Tesla's prospects, then you better keep watching this video. According to Meet Kevin, the second quarter will probably be the toughest for Tesla, and then the company is looking to bounce back. Therefore, it seems like Tesla's stock price will not drop much more and will soon head for a strong recovery. This will hold unless China's president decides to shut down the country again completely, in which case Tesla is going to be affected as one of its main factories is in Shanghai. As Meet Kevin believes that Tesla's stock price will not fall much further, we estimate that it's not going to go below the $600 per share mark. Meet Kevin also claims that the second quarter's earnings per share, EPS, is looking to be lower than the first quarter's EPS. However, the statistical forecast should not get you discouraged, as there are other circumstances that have got to be considered when predicting Tesla's future. For example, the regulation in the autopilot industry is increasing, which is actually not a bad thing considering that Tesla's a forerunner and might actually have the ability to influence this development of the regulations. Meet Kevin also believes that Tesla's stock price will not only stop dropping, but will also be looking to bounce back, and it's going to have a real price explosion. One of the main reasons for the Tesla 3-for-1 stock split that we covered in our previous video is this reason alone. According to Bank of America research, quite often companies that engage in stock splits, in the end, outperform the market. The rationale behind this is that more investors buy shares in a company as there is a perception that the stock sells at a discount. As more and more investors rush to buy the company's stock, the process will gradually rise. In order to predict what might happen with the future of Tesla stock prices, Meet Kevin turns to research the company's past. One of the main estimators are Tesla's deliveries, and looking at the previous quarter, Meet Kevin explains that Tesla's actual deliveries of 254.7 thousand did not meet the expected range of 255 to 268,000. An interesting number Meet Kevin refers to is the SX deliveries that were over 16,162, which constitutes an approximately 10% increase in the production of the S and X vehicles compared to the previous quarter, despite the Shanghai factory being shut down due to COVID regulations. Tesla also just released some financial documentation showing that the company produced more vehicles in July than ever. This shows that Tesla is well on the path to likely recover its stock price soon. According to Meet Kevin, if Tesla keeps up this pace, then Tesla might be looking to produce about 1.8 million automobiles per year, while the market expectation is 1.4 million vehicles. It's an excellent sign that Tesla's going to bounce back soon. Meet Kevin, in his forecast, explained that Tesla is predicted to manufacture 1.4 million vehicles in 2022, and that's a 50 to 60% growth, which is going to see Tesla produce 2.2 million cars by 2023, 3.9 million by 2024, and 5.8 million vehicles in 2025. What is also important is demand, and it looks like there's enough demand for Tesla automobiles. Indeed, people are currently buying electric vehicles from other companies, but it might be the case because they're unwilling to wait for Tesla. If Tesla made enough vehicles to cover the EV demand and no one had to wait months to receive their car, then more people would buy Teslas. Therefore, Tesla has a lot of untapped production growth, as many people are potentially Tesla buyers that are, in a way, forced to buy other electric vehicles that are more available, but are in reality Tesla buyers. This is great news for Tesla, as it means that the car company can actually still grow at a very high rate of about 50 to 60%, with revenue per car hanging at about $52,000, which might increase in the future. Well, we've got to keep it even at $52,000, because that brings us to over 300 billion USD in revenue in 2025, considering that Tesla will deliver the expected 5.8 million vehicles. Including other revenue streams, total revenue in 2025 might be about $355 billion. Let's also keep in mind that Tesla has one of the more unique advantages. Tesla does not have an extra layer of dealers. That's actually very beneficial to margins, as dealers usually take about 10% of the car's sale price and then pocket it to keep up the dealership. This is called dealer markup. Tesla avoided this whole dealership scheme and took the 10% into its own pockets instead of losing it to the dealer. It's great news, and it benefits the company's margins, and many investors overlook this and do not take this information into account. Currently, Tesla has a 66 price-to-earnings ratio. It's not a bad number, but it might be depressed considering the current economic situation, COVID, geopolitical tensions, and so on. This means that Tesla might have a higher price-to-earnings ratio in the coming years. However, let's not get over our heels. If Tesla can keep up the 66 price-to-earnings ratio and approach 2025 with it, then Tesla's stock price should be around $2,200 USD per share in only 4 years. This represents an annual rate of return of 33.57%. According to Meet Kevin's predictions, Tesla is looking like a fantastic company to invest in, as its stock price will not drop, but it will increase significantly, bringing its investors a great return in the long run. Please do keep in mind that we are talking about a longer-term investment here. Short-term investments might not bring a return, as the current market volatility makes it incredibly hard to predict what is going to happen in the nearest future. Another important aspect Meet Kevin considers in his video is Tesla laying off 10% of its workers. Some investors are taken aback by these recent layoffs within Tesla. However, as Meet Kevin mentions, we find that Tesla mainly laid off labelers. This does not mean that the company expects to produce less or anything like that. It simply shows that Tesla is an advanced AI company and it does not need human capital to do some of the mundane tasks. However, there were other workers leaving the company, and this is true. But this is a good sign, as it means that Tesla is not oblivious to the current economic situation and possible recession. The company is preparing for tough times and cutting its expenses. According to Meet Kevin, this is normal considering the current climate, and investors should not get too discouraged by these layoffs. Letting go of some workers gives Tesla an opportunity to increase its earnings during the recession by cutting off some extra costs, which is exactly what investors want to see. This is especially good in light of the approaching earnings recession, a term Meet Kevin refers to in his Tesla videos. An earnings recession means that a company has a negative revenue multiple quarters in a row. This is already happening for some big companies, for example Nike, which repeatedly declared a negative revenue of about 5%. As Tesla has done, minimizing expenses through layoffs can help avoid the situation and keeps the company growing. Therefore, as Meet Kevin uncovers in his videos, many things that at first seem like bad signs for the company turn out to be good things that companies do on purpose in order to protect themselves from harsh, volatile times. Another good sign that shows that Tesla's doing quite well is the positive cash flow for the company. As Meet Kevin mentions, every day there is more cash coming in rather than leaving Tesla. It's amazing for a startup company, especially in the automobile industry, as many car companies in the US have actually gone bankrupt. It looks like Tesla will be able to avoid such a destiny. However, if Tesla's cash flow turns negative for some reason, this might have an unfortunate effect on Tesla's stock price, as many investors will likely get uncertain and won't be willing to invest. For now though, according to Meet Kevin analysis, it looks like that Tesla's cash flow is going to stay positive. To conclude then, Meet Kevin suggests in his video that Tesla's price per share will not go down much further, and we believe that it won't go below $600. There are many signs that Tesla will bounce back and its share price will significantly improve in the long run. As Meet Kevin explains in one of his Tesla forecasts, the company's stock price should be around $2,200 USD per share in only 4 years. But do let us know what you think about Tesla's future. Share your predictions and forecasts in the comments down below. Thanks for watching. Please check out the rest of our videos, like, comment on this video, and most importantly, subscribe to the channel. While you're still here, go ahead and click on one of these 2 videos on your screen. See you there!